Man walks into a bank in 1930. He just wants his money. By the end of the day, the bank is gone. Not weakened, not struggling, gone. And here's the uncomfortable truth. Nothing physical was stolen. No vault was emptied overnight. No heist, no fire. The bank simply ran out of belief. This is the story of how thousands of banks collapsed almost instantly during the Great Depression, and why the system was far more fragile than anyone realized. And here's the part that should bother you. The same basic system still exists today. Let's start with what people thought a bank was. In the 1920s, if you deposited $100, you assumed it sat somewhere safe, maybe in a vault, maybe loaned out carefully, but ultimately available whenever you asked for it. That assumption was wrong, because banks don't just store money, they transform it. Here's how it actually worked. You deposit $100. The bank keeps maybe $10. It lends out the other $90. That $90 gets deposited somewhere else. That bank lends out most of it again. Very quickly, your original $100 turns into $300, $400, even $1,000 circulating through the system. This is called fractional reserve banking. It works beautifully until people want their money back at the same time, because the money isn't really there. It's out in the world, locked in loans, tied up in businesses, sitting in assets that can't be quickly sold. So what happens if everyone shows up at once? The bank doesn't slow down, it breaks. Now rewind to 1929. The stock market crashes, headlines spread, people lose fortunes overnight. But the crash itself wasn't what destroyed the banks. Fear did. One rumor, one whisper, one neighbor saying you should probably withdraw your money just in case. That's all it took. Because banking is built on confidence, and confidence is fragile. A few people show up to withdraw cash, then a few more. Then a line forms outside the bank. Now something strange happens. Even people who weren't worried become worried, because the line itself becomes evidence. If everyone else is withdrawing, maybe I should too. And just like that, a bank run begins. Here's the part that feels almost absurd. The bank might have been perfectly fine the day before. Its loans were still being repaid. Its assets still had value. But it didn't matter, because banks operate on timing. Their assets are long-term. Their liabilities, your deposits, are short-term. When too many people demand cash immediately, the math collapses. The bank has to sell assets quickly. But in a panic, everything is sold at a discount. A $100 loan might only fetch $60. A property worth $10,000 might sell for $5,000. Losses pile up instantly. And now the bank isn't just illiquid, it's insolvent. Between 1930 and 1933, over 9,000 banks in the United States failed. Not gradually, suddenly. Entire towns lost their savings overnight. Imagine waking up and your bank account simply doesn't exist anymore. No insurance, no guarantees, just gone. People who had spent decades saving lost everything in a week. And here's the twist. The more banks failed, the worse the economy became. And the worse the economy became, the more banks failed. It was a feedback loop. Businesses couldn't get loans, they shut down. Workers lost jobs, they stopped spending. More businesses collapsed, which meant more loans went unpaid, which meant more banks failed. It wasn't a single collapse, it was a chain reaction. Now let's talk about what made it worse. The system had no real safety net. Today, if a bank fails, deposits are typically insured. Governments step in. Central banks provide emergency liquidity. Back then, none of that existed at scale. If your bank failed, you stood in line with everyone else, hoping there was something left. Usually, there wasn't. And without a central authority stepping in quickly, panic spread from one bank to the next. A failure in one city triggered withdrawals in the next. It didn't matter if the next bank was healthy. People weren't checking balance sheets. They were reacting to fear. There's also a deeper, more uncomfortable layer. Banks weren't just victims of panic, they were exposed. During the 1920s, many banks took on excessive risk. They invested heavily in stocks. They issued loans with little oversight. They assumed the boom would continue forever. When the market crashed, those risks didn't disappear. They surfaced all at once. So when people rushed to withdraw money, they weren't just testing the system, they were revealing its weaknesses, and the system couldn't handle the truth. By 1933, the situation became so severe that the US government did something unprecedented. It shut down the entire banking system.
Every bank closed. For several days, no one could withdraw money at all. This was called the bank holiday. It sounds extreme, but it worked. Because it stopped the panic long enough to rebuild trust. Only the strongest banks were allowed to reopen. And gradually, trust returned. So what's the real lesson here? It's not just that banks can fail. It's that the system itself depends on a shared belief. Your money is safe because you believe it is, and because everyone else believes it is. The moment that belief cracks, the system behaves very differently. Not slowly, not logically, but all at once. Today, the safeguards are stronger. Deposit insurance, central banks, regulation. But the core structure hasn't changed. Banks still lend out most of the money you deposit. They still rely on confidence. They still can't handle everyone withdrawing at once. Which raises an uncomfortable question. If the system depends on trust, what happens the next time people stop trusting it?